safer.
Got it. Okay.
Cool. All right, everybody. Welcome to the Multifamily Masters Meetup. We're really grateful to have you here with our co-hosts, Brian Kochendorfer, Mandy McMallister, and some of our panelist speakers, Spencer Hilligoss, Sandhya Seshadri, as well as KK Singh. So some quick little logistical items, and then we'll get into it. Multifamily Masters is a global grassroots community really nurtured around networking and building teams and education on multifamily so that you can grow your wealth and basically utilize real estate in some of the most powerful ways possible. So a lot of what you're going to hear today is for educational purposes. We have to kind of do this little disclaimer. Make sure you kind of verify any of the information with licensed professionals, but we are here to provide a wealth of knowledge, hopefully give some insight on what it's like being a passive investor and kind of the right questions to ask, especially in this particular market. I'm gonna do a quick little intro to, hold on one second. Before the intro, we're gonna go through the panel. After, we're gonna have some Q&A as well as some networking event. I know that's been kind of the hot thing. So, about 8 o'clock Central Time, we'll do some networking, break out into groups, and then I don't know if I'm gonna steal some thunder, but we have a little bit of surprise at the end, so stick around to the very end.
Yes.
Big surprise.
One thing, guys, if you have questions as we go, make sure to put them in the chat, and then we'll keep track of them, and we will address them at the end.
Yep, yeah, please, we want this to be interactive as possible. If you have specifics, there's a wealth of knowledge in the room, so please drop them in the chat box, and we'll make sure to source those questions at the tail end. I'll do a brief intro, and then I'll let Spencer, Sandhya, and KK do a more detailed intro. But basically, Spencer Hilligoss of Madison Invest, professional real estate investor, co-sponsor, tech leader, spent 13 years in tech, growing high-performance teams, and across 3 unicorns, 600 million in assets, over 5,000 units, retired tech leader. We have Sandhya Seshadri. She was a leader in equities markets for over 20 years, moved in commercial real estate to really focus on some of the tax advantages and the ability to uniquely force asset appreciation. And she's a limited partner, KP, and general partner in over 3,000 doors, 200 million assets. And then lastly, but not least, KK Singh came to America back in 2000, built a business buying gas stations in India, grew this business and owned several gas stations here in the US in the Fort Wayne area, built a high technology laundromat, and then in 2014 started to focus on single families to 40 and then transitioning over to multifamily. So very impressive track record we have with our panel and tremendous guests. I'll pass this off to Spencer first if you want to add anything additional, please.
Yeah, well, thank you for doing 3 back-to-back intros. I don't think I've ever heard it done so efficiently and so clearly. So kudos on that. Thank you so much for letting me join you guys and spend the evening together. So just to add to that, I think you captured it, really well. But I spent 13 years in the technology business. I'm based out here in the Bay Area, California. I'm actually sitting on this little island city called Alameda. It's tucked right between Oakland and San Francisco. I followed for so many years the traditional path that a lot of folks tend to, which is you work a high-powered, very focused leadership track. And I thought somehow I would end up getting enough equity in an early stage startup that would somehow have a Google or Facebook exit, and it would somehow absolve all the sins that we had made financially along the way. So long story short, that didn't happen. Ultimately, we realized our 401ks were not going to get us to where we wanted to go on our objectives. And so when I say we, I mean Jennifer Morimoto, who's also my co-founder in our business. So we are passive investors, or LPs. That's how we started. We did go through a very brief residential phase, as well as so many people in multifamily tend to. So we invested in, turnkeys. We bought a local duplex before we were comfortable going sight unseen. And now we've kind of gone the full gamut. And now we are also in the GP in a bunch of deals and ongoing. And that's our active business. So we help other folks get in on the very first few kind of as an LP, because it's intimidating. Even as a passive investor, many of you on this call could probably agree to that. It's intimidating, and getting into it is not like a target date fund. You really you gotta spend some time, and I love a good framework. And I think that was the biggest takeaway I'll stop on before I pass the mic to the rest of the really awesome panelists here, which is high growth tech startups taught me the value of frameworking for making great, consistent decisions. And if you haven't built one yourself, just for your own criteria, then I'd strongly encourage you to do that. It would really, really helped me. And we have the same one that we built before our first real estate investment that we use now. We've just evolved it and we've deepened it. So I'll probably just save the time for the rest of the smart folks on the panel, though. Really excited to be here, guys.
Awesome. Sandy, how about you? We'll throw to you.
I moved here to the Dallas area 30 years ago, directly all the way from India, and I've stayed here ever since. So this is my home. I love Texas for investments. I love it for business and for everything being so huge and vast. I just love Texas. So that's where I tend to focus my investments in. So I was first an electrical engineer, and then I got my MBA, and I worked for Texas Instruments locally here for over 15 years. And then I went on full-time into the stock market when I had kids and family commitments were bigger, and my stock market investments were able to pay for all my expenses. So that worked out really well. And I love the traditional path, actually, because a good education and working hard in a company helped me build my portfolio. And then the investments in the stock market allowed me to start multiplying and playing around, because I had built this portfolio initially from my traditional world. So what brought me to real estate is when President Trump took over, and everyone is, knows that he pays zero in taxes. That's what really drew me to real estate. It's like, I either need to start my own business or get into real estate. Every rich person I know is in real estate. McDonald's is all about real estate, even though we think of it as a fast food company. So I wanted real estate. And the tax savings have been fantastic, even as a passive investor. So like I said, you will start defining your own criteria. And for me, the location, Texas, is very important to me. You want to make sure you invest in landlord-friendly states, but we can get more into that in a little bit.
Awesome. KK, let's throw to you, please. Update us a little more on your path here.
Thank you very much, Mandy, for having me on your panel here today. It's been great to turnover, and also it's been great having a relationship with you for a while. So first time we met in Chicago, Brian met me in Chicago as well. And nice to see you, Sandhya and Spencer today, and everyone else. So I came here from India as well in 2000 as a Microsoft certified system engineer. And I soon lost my job after about coming here less than a year. And at that time, I was on H-1 visa, and I had no other choice, but I started working at a gas station. So from there, I partnered with my friend of mine to get into the gas station business. They needed somebody who was well educated and computer savvy, because they were not well educated and computer savvy. So they gave me a share. Actually, they gave me a share. I didn't have to buy into it. So they gave me a share, 30% share in the gas station to start with. And slowly I kept growing. I moved to Fort Wayne from Indianapolis because there was an opportunity here. So I've been here 19 years in Fort Wayne. And in 2014, somebody offered me a portfolio of 40 single family houses. And he convinced me to buy. I knew nothing about the real estate business. Though I owned some gas station real estates, but this is totally different from owning a gas station real estate. So I started managing those 40 single family houses myself just to learn the business. And I soon realized that this is not something that I should be doing because of the taxes. Again, I have the same story as Sandhya. I was paying a lot of taxes because of my gas station business, banquet hall business, laundromats business. So I was paying a lot of tax. So I was looking for something to save money on taxes. And so I started investing in multifamily as a passive investor. And so far I have invested in about 2,700, 2,800 units, over 10 different properties with 5 different syndicators. And also I am a general partner on 3 of the properties.
Very cool. I didn't know that whole story about you. I love that sweat equity really started your journey. And, I'll tell you, so what we're doing here is, COVID forced us into the Zoom virtual world. And we, in the Chicago multifamily meetup, decided that we were going to do a passive investor summer series. So this is basically episode 2 of 3. And you guys, we scoured all of social media, all of podcasts, all of everything to come up with the 3 very most astute passive investors. So we could not be more thrilled that the 3 of you have agreed to join us today. This is a really big deal. So thank you so much for everyone involved. Yes.
Thank you.
Yeah. So, last week we dug a little bit into, definitions of KP, LP, what is passive investment, kind of the more broad setup of what is passive investing. I'd love a chance to, you guys are the absolute experts. You are the ones really making waves in passive investment. What I'd like to know is, we'll kind of go down the line here, but first and foremost, what made you choose to invest passively? Spencer, let's start with you.
Yeah, and happy to speak to it. And thank you for those very kind words, by the way. There's a lot of other people that I consider far more intelligent than me, but I'm very appreciative to be here. I think when I was working full time, we had gotten to the point in our careers where we had solid W-2 income. Very, very similar narrative, I think, to so many folks out there on the taxes, where I came from an operational and sales leadership track. I bounced between those worlds, sometimes heavy compliance operations, sometimes sales. But the point is, I was taxed. I've paid so much in taxes in my lifetime. And I'm thankful that those contributed to our society at large and our infrastructure, et cetera. However, I really, really like the sound of paying less. So that was the first thing that stuck out to me, was how can I go and do this without impacting the time component for me? There's this really nerdy acronym. Maybe you guys have heard this, but I got this from a former mentor of mine in the corporate world. It's called LIMFACTS, or limiting factors. And there's 3 limiting factors that were so important when it came to deciding what strategy that we wanted to use for our own wealth plan, as well as what asset classes we wanted to focus on for our own wealth plan. Because there's a big difference, as you all know. If you're looking at this real estate, category, it's overwhelming, just utterly overwhelming. And you have active types of strategies, you have passive types of strategies, but on the passive side, you could buy turnkey properties. People say that's passive. You can go and try to buy a rental, fill the rental yourself, get cash flow from that. Or you can go into this wonderful place called being an LP within multifamily. So we looked at all that, and we used this acronym to guide us that said, you have 3 different limiting factors. You have time, you have capital, and you have expertise. We all have the same 24 hours in a day. So, even Bill Gates and Oprah, somehow they read all those books that we all read about and all these articles all the time. I don't know how they do that quite yet. But beyond that, capital doesn't just mean money. It also means relationships. And so we looked at the relationships we had, and then we looked at expertise. I had the one unique advantage of working at a tech company and a lender at the same time. So I actually worked at Lending Home for about 3.5 years right before I decided to retire from my tech career, just about 7 months ago, by the way. So yeah, it was a big milestone. So we're right before COVID-19, right? But passive investing plays a big role in that. And in terms of deciding on strategy, I hear so often now people reach out and they ask, hey, what do you think? Should I go all multifamily, or should I go all self-storage, or should I go to buy turnkeys, yada, yada. And the point I want to leave this on before I pass the mic again would be, it's so tempting to just jump in and take action and pick a strategy and run at full speed and spend, if you're well capitalized, to go and drop a very irresponsible amount of money into an investment. Our first investment was a duplex in Vallejo, California, in real estate. And it was a $430,000 purchase price. And the cash flow is $250 a month. And so when you don't know how to cash flow goal set, that's the kind of stuff you go do. And coming back to the really awesome comment that was made earlier about business friendly, business-friendly environments. I live in California. So I picked one of the very rare cities that is more friendly to owners and landlords, but I would say it's coming. It's coming. Like a change will come where it's less favorable to buy here. So be thoughtful and you got to take your time. And we try to take our time thinking about the passive nature of a strategy. That's also why we stopped buying turnkey properties. I'm not saying they're bad. We still own them ourselves. We have 5 of them. They're in Kansas City. They cash flow fine. They were $50,000 to $60,000 a piece, and they cash flow about $200 to $250 a month. So they're not passive. They are semi-passive, because rentals are not passive. I don't care what anyone says. So it's just not a fact. So rentals can be very close to passive, sure, but they're not fully passive. And that was a hard learning we had to get when we saw the first eviction come through. So I know I just talked at you guys a lot, but I just wanted to share
There's a
the
ton
journey.
of nuggets in there. I want to maybe sum up a couple of ideas to make sure that I'm taking notes of the salient points. That the limiting factors of the capital of relationships and the time that you can put in and the expertise you can possibly have in one piece of real estate, namely multifamily. It takes a lot of time, it takes a lot of capital, it takes a lot of relationships and a lot of expertise. So to leverage a sponsor's, utilization of those things really kind of puts you in a increased spot. And also the opportunity to have something that is significantly more passive than the mildly passive turnkey is what you find significantly attractive.
Very much so. Yeah, I mean, borrowing the expertise and allowing that to help you de-risk an investment is just critical. I mean, so many of us are conditioned to think that real estate is really what we heard about in that one pivotal Thanksgiving meal or Christmas dinner. And then, old Uncle Joe, not to pick on if you actually have an uncle named Joe, but that relative of ours told that one story about how they lost their shirt in real estate. And that forms most of our opinions on real estate for the rest of our lives, unfortunately. Not the case. Most people out there, I would say, are out there to do good. Most people are out there to help, but you have to be selective of who you choose to work with, which is why, I mean, I would probably spend 70% of my effort before going into an investment passively on the who.
Yes.
Before I even go, I mean, this doesn't mean this is the right plan, guys, but I'll just say, so many people start with the where. Yeah. I am not that person. I start with the who, then I go to the where.
Awesome. Let's stick a pin in that, because that is absolutely something I want to get at next. Sandhya, would you mind telling us why passive investment was your answer?
Passive investing in anything, to me, is the best way to learn the business, because you get all these monthly reports from sponsors in the case of multifamily, and you get to see what is important to you. You pick someone who's very experienced, has a good track record, and you want to be like them one day, right? So you invest in a deal with them, and you get these regular reports, you know what their criteria is, and you start putting together your own little criteria. And for me, yes, location, Texas is important, but first, the foremost thing is to vet that sponsor. So another piece of it is that once I had quit my corporate job, I have all this retirement money that I'm only limited to certain funds that I can put it into. I can't just pick a stock and say, I want to go buy the stock. I didn't have that flexibility. So the retirement funds were perfect to learn the business, because I could roll it into an IRA or a solo 401k and invest in real estate. And if I wanted to learn the business and do it myself one day, which I ended up doing, I did sponsor a couple of deals. The retirement money is not something I can use in my own deal.
Right.
So passively investing was the best way that I could get the advantages of real estate and learn the business without actually taking the risks myself, because it is a lot of risk to guarantee huge loans with Fannie Mae and Freddie Mac. And you also get to leverage other people's time and expertise, as Spencer just mentioned. So I get the concept of making money while you sleep, so to speak, as these real estate assets appreciate and you get your regular cash flow. But at the same time, I'm not taking on all the risk. I get to sleep at night, not worrying about evictions and tenants and apartments catching fire and all of those other issues that I read about as I get these reports. And I see which sponsors do a good job of managing those things, who has a good track record, and what do I want to emulate take all the good points from each one when I do my own deals. So passive investing to me in anything, in any business, is one of the best ways to learn the business, develop a relationship with those sponsors so that when I'm sponsoring my first deal, I have all these people I can call on and say, hey, I remember I invested in your deal. I'm running into this problem here. Can you help me? So again, you build the relationships, as Spencer mentioned too. So,
great point. Learning what you want to see, building those relationships, building your checklist of what's important.
And leveraging other people's time and money.
Absolutely. I think that's so smart, especially if you're entering in a place of learning, you know. KK, you mentioned that you've done both active and passive investment. In terms of the passive investment, why was that the choice for you when it was the choice for you?
The main reason for me was the taxes, because with my all those businesses, I was paying a lot of tax. When we bought this 40 single families, I thought now we are real estate investors. Now we are not going to pay any taxes, but we ended up paying even more taxes because that half a year we had another extra 70,000 of cash flow from that particular entity. And I asked my accountant, what's going on? We are in real estate now. Why don't we get, he said, you'll have to have some kind of minus K1s. I asked him, how do I get those? And he said, probably investing in some asset type where you can get the cost segregation. That's when I first learned what cost segregation is.
Very cool. Well,
So,
for our newbies that are in the crowd, a K1 is the document you get at tax time that shows the paper loss due to appreciation. A cost segregation study is something you do to really amplify those depreciation terms. That's something that can be really juiced up due to some tax law that was passed here recently that's phased out, I think, 2023. So just kind of a sidebar.
So immediately I invested in one deal without doing much research and anything. And I thought every investment is the same, but luckily that was a good one. So I invested and started learning from there onwards. And then I found that no, it is like doing a business. It's not just sending a check. It's like doing a business. So because I started networking with people, started receiving a lot of OMs, and then I had a choice to compare which is a good one. And to do all that, I had to learn a lot to pick a good deal, which is a good deal, who is a good syndicator, who has got a track record, who has been through this full cycle and all that, because there's a lot of noise. Everybody is trying to get your money. So I started learning, and I learned how to underwrite these deals, how to bet these deals, how to find good markets. So I'm invested also in Texas on 6 deals.
Well, this dovetails really kind of perfectly into what I was hoping to talk about next. When you're underwriting deals, namely what that means for our newbies is doing the math on and checking deeply into deals. What is really the first couple of things you look at that you spend a lot of time in? KK, why don't you just go right into that, please?
Well, over these years, I have joined so many groups. I have my own Facebook group, and I know most of the people in this space. So that's not a problem for me. I know who has done deals, who has done been through the cycle and all that, and from all group. Not I'm mostly, and you are into Rod Cleave's group, and I'm also a member of his boardroom mastermind too. But I am, because I have invested with other people as well, so I know most of the gurus and everyone in this space. So I mostly look into the deals itself. So of course I look at the syndicators, the key sponsors, and then I mostly look into the deals. What market are they in? What kind of deals are they in? And I started investing in like C properties, and then I thought, no, B property is better. So I moved on from C to B properties.
Okay. What I think I heard was first the people, then the market, then the deal. Is that accurate?
Correct.
Okay. What about you, Spencer? You kind of alluded to this a question ago. So why don't you catch us up on the balance of that answer, if you don't mind?
Yeah, and did you want me to go purely into the deal, or maybe just holistically underwriting the whole project?
Right. Well, you have decided you are a passive investor in the waiting. What are the first couple of things that you're going to do for a brand newbies who want to invest passively?
Yeah, 100%. I think KK just hit on this really well by telling his own story, which is, man, there's a flood of information, and it is so completely overwhelming. You know, and this is coming from a guy, by the way, I try not to bring this up too much because I don't like to ride coattails, but like I grew up in a real estate household. So my dad was a broker. He was one of the top ones in the country for 30 years. And this is all the way back in the 90s. So like, as a guy who thought I understood real estate, because I literally grew up inside a real estate business, I didn't know much about commercial. And so getting to places like Bigger Pockets and working inside of a lender for 3 years, these are things that open my eyes to like, wow, this commercial real estate stuff, it has some commonalities between residential, you know? So if you've never bought your own home, let's say, that's absolutely fine. You can go straight to go passively invest in multifamily. And for some people, that aligns really well with your goals. But for me, I just had to go learn. And I don't think everyone has to necessarily go and do what I did. I got weird. I went and read 24 books. I listened to 400 podcasts. It got a little over the top. And so in hindsight, I'm always happy to share that book list if anyone wants to see it. I had someone on a training session I did the other day who asked for it. So I'm happy to send the Google link if someone ever wants to see it. I tell you what I would read again and what I wouldn't. But I look at it like this. I literally have a spreadsheet in front of me. You look at the sponsor or the who, because sometimes the terminology will just drive you crazy, guys. If this is your first time doing it, the sponsor means the operator, means the GP, means the lead sponsor. It means all the same thing most of the time. It's the who. It's the person managing the deal. Then you look at the where, and the biggest thing that we look at in the where is not just at the MSA, which is an acronym for basically saying the metropolitan statistical area, the big geographical footprint around a city. Chicago, big MSA. So you got to go all the way down to the street, like literally down to the neighborhood to do it right. Because you can buy in a great MSA, a great market overall, a great city, but you can buy something and not really realize, like particularly if you're not going to be seeing it firsthand, that thing is on a pretty rough block, and it might not necessarily be aligned with your strategy. So we look at those things, and then we look at the deal. And so one comment I'll make on the deal is that criteria and goals matter so much. And I used that example earlier, guys, of the first property we bought after our home. It was a duplex in Vallejo, California. It's appreciating, you know, and everyone says when they're kind of getting into real estate investing, you buy in a coastal market, it'll appreciate, right? That might be a great strategy for people who don't care about making an income from these properties. And if you look at something like a development deal, let's say that you want to go invest in something that's never been built, it's new construction. And so you're going to invest alongside 100 other people to buy a piece of land for something that's a beautiful picture right now. And at some point in the future, you'll have a beautiful return, no income along the way. That's a different type of deal. We were looking for cash flow, and understanding cash flow and wrapping your head around that and looking at things like Bigger Pockets and the forums on biggerpockets.com is a wonderful place to start. And I think going there first and realizing you can go talk to people, and most are givers. Like most people on there truly want to help. And I think that most people, like here, I love the real estate investing community because it's such a wonderfully positive community generally. I mean, you can't go in naive and expect that every person's going to be there with the right reasons, but I would just say that most of them are. So go in understanding what you're trying to solve for. Don't just go in and say, I want to buy something. Figure out what your number is. Like if you're doing this for income, what level of income, what target, and is that project you're looking at going to be something that helps get you closer to that? So, because if it doesn't cash flow, but it's a beautiful offering memorandum, because earlier KK said the term offering memorandum or OM, that's just a fancy way of saying the fancy packet. Every deal will have a very fancy, attractive, well-structured packet that probably cost them some money or a staff member to put it together. And if you get fooled by that alone, you may not be looking at a great deal. I mean, you have to look at the numbers and you have to understand the cash flow. And if a project looks great on paper, but doesn't actually produce an income for you in any way, maybe it's not a fit.
Mm.
So just start talking to people, start networking, and put yourself in situations where you can try new terminology, and then just skin your knees a little bit, because that's the way you actually learn. Eventually, the books don't do anything.
Or the 400 podcast, right? We've had
Or
a
the
couple
400 podcast.
for that. I'll follow up, but that book list would be super interesting to the group and me personally. So
Sure.
I'll hit you up for that. You know, so basically what I heard is, again, people first, but then decide your goal before you dig in to, you know, a bunch of different shiny OMs. I think that's really a golden nugget. Sandia, what's the first, you've just decided it's time to invest in real estate passively. What's the first thing that you do?
First thing that I do, and I tell my friends who want to be in real estate as well to do, is make sure you have 6 months of living expenses saved somewhere. Because real estate is not as liquid as stocks or anything else. So you may not see your capital back for 5-6 years sometimes. So make sure you have enough money saved before you are ready to put it into real estate. And that's why something like retirement funds are perfect, because you're not betting on that money to be available to you anytime in the near future. So beyond that, once you've actually been presented a deal, I would first look at the sponsorship team, like everyone else has said. And so while someone might have a great name and have a really good track record, do they have any experience in this particular market where they're presenting it? And do they have experience in this type of deal? So for example, if they've only done yield play kind of deals, which basically means the property is doing fine, they're just taking it over, making some minor changes, and it's cash flowing right from day one. That's different from what we call a deep value add deal, where the vacancies might be like at 50%, and they're going to take this property in a bad neighborhood, turn it around. There's a lot of rehab to be done. And so it might be a while before they start cash flowing. Does the person have this kind of experience? Does anyone in the sponsorship team have this experience? That's one of the things I look for. So within the sponsorship team itself, there's a lot of questions to ask. And so as Spencer said, a sponsorship team is basically the general partner, whoever is presenting the deal to you and asking you for your money. So one of the first things is in researching that sponsorship team and the location and the type of deal, and to make sure the sponsorship team has skin in the game, which means they have at least the minimum investment that they're asking you to invest. Make sure they're also investing at least that much money in the deal themselves. And then you go on to the structure of the deal. Do they reward themselves upfront as soon as they close the deal with a large acquisition fee? Where would you find it? You would find it in the closing costs. So see if they're rewarding themselves with a pretty large acquisition fee up front, or they're structuring it more to where, hey, I'm going to give you a really good return as a passive investor, and I'll reward myself once I hit a certain return. Mm-hmm. Do they give you preferred returns as a passive investor? Do they reward you first before they reward themselves?
Well, tell me a couple rules of thumb on that, if you don't mind. What would you say is a quite high or an average acquisition fee? What do you think is a good pref that you're seeing now?
So if you are a very established, famous name, experienced sponsor who has this automated system, and month after month after month, it's like a machine, they go 3-4% in acquisition fees, right? Versus if you're a relatively new sponsor, they've only done a few deals, I would say not more than 1%. So again, it depends on the experience, the reputation of the sponsorship team, then they can get away with it. It's sort of like, I'm going to pay a little more for Coca-Cola versus a generic brand until the generic catches up, right? So it's kind of like that. Once you have that reputation and you've shown a consistent track record of all kinds of deals, and those passive investors who invested with this sponsor come back and say, oh, this is a great sponsor. They have a lot of references that are all positive, and they're willing to share their track record with you. Yes, then you could probably get away with a little more upfront acquisition fees. Or what I've seen also is what I call the waterfall structure at the end of the deal, when they're selling the property and they're ready to cash out and give you your principal back. Instead of taking an 80-20 or 70-30 split, they may even go up to 50-50 split once they've given you the returns that they promised you. So it varies.
If they knock it out of the park, they get to share in a greater percentage of that.
Right.
In terms of a preferred, you also mentioned preferred return. What's a normal preferred return that you're seeing these days for folks that are going to start underwriting?
So if I look at a COVID time, with some of the returns not really happening the last few months, I would say you should still average about a 7% a year on a fairly good deal, which was stable before COVID started. Now, if it was having problems before COVID started, okay, then it's going to be much worse. But if a deal was stabilized before COVID hit us, you should be at least getting 7% cash flow.
Oh, can I get your opinions, you guys, on just what a normal acquisition fee and preferred return would be, just for measurement purposes? Are you seeing the same things, KK?
Yeah, I have seen from 1 to 3%. But again, just as Sandhya mentioned, that established syndicators like to get a little bit more. And I have seen even 4, which I didn't invest in, but I have seen from some OMs it's even 4, and they make excuses because this property is not cash flowing for the first 2 years, so they want to make money up front. And there are variations of fees, but I think anything between 1 and 2 is pretty normal.
Reasonable. How about a preferred return?
And also it depends on the size of the property and the value of the property as well. Preferred return 7 to 8%. Okay. Nothing less than 7 to 8%. No preferred return is a red flag.
Okay. How about for you, Spencer?
I mean, I think Sandhya and KK summed it up so well. I really don't have much to add to that beyond the fact I've never gone for anything above a 3% on acquisition fee. And I do think that prefs are interesting because, you know, you are seeing a lot of difference. We were talking about multifamily, so I think one thing that's worth calling out, and I think KK just hit on this, which is really important. Multifamily means a broad range of size, and it means 5 units is multifamily, the way that we're describing it here. And that is, I think most of the folks, I don't know if I could speak for you, for Sandhya and KK, but like most of us are talking about relatively large properties, you know, so we're talking probably at least, if not flirting with 100 units plus, then certainly north of that, and probably maybe 80 to 100 units. And so at those levels, you're probably going to see like a 7% pref right now, which is fairly common. The thing that I wanted to add that I don't think we've really touched on yet is cash flow in the first year. You know, I think cash flow in the first year from the operations is not necessarily, like, one of the toughest things I found when I was first a passive investor was I wanted to just steal everyone else's exact criteria because it's all that I knew. And so it's super tempting to just say, oh, I heard this person speak, I'm going to do what they did. And that's good. Like one of my mentors would always say, be a thief of good ideas. So please do, you know, if you hear good ideas, please steal them and use them, but tailor them to your own needs. And eventually you'll get really comfortable with that. The thing that always brings me back to center when I'm looking at a deal and I'm being indecisive is I just think, okay, cash flow, let's look at how this thing is performing operationally. Is it going to be able to sustain itself in the first year as close as possible to day one? Right now, that's kind of tough to find. So I would just say you have to readjust a little bit. And I think so many conversations, if you look at February to now, we are well out of it's the same questions, but we have moved from the theoretical sky falling to, well, sky ain't falling, but we're living in an interesting time. And so we're in the actuals. So what happens when a black swan comes? What happens when a pandemic comes? So frankly, there is a small glimmering silver lining there to say, we are seeing what happens when a pandemic comes. We are seeing what happens on cash flows. We are seeing what happens on preferred returns. And so 7 to 8% still the norm for me on large properties for multifamily, and 3% is certainly the highest I go in acquisition.
Mm-hmm. Very cool. It's neat to hear seasoned passive investors see similar things. So thank you for sharing that with our group. And why don't we start ladies first on this one, Sandhya? In terms of a major red flag, if you get an operating memorandum, an OM, and you're about to start looking at it, what are some of the first things your eyes go to? And what are some of those red flags that maybe tell you a syndicator or a sponsor doesn't really know what they're doing in terms of that underwriting that you see?
A super high rent growth starting from day one, because first of all, There's an existing tenant base, the rent roll that you can look at. So probably not all the renewals are going to happen on the day one that you take over the property. And in fact, the opposite happens, because in order for you to qualify for a Fannie or a Freddie loan, the seller is going to make sure he has high occupancy, or he or she's, before they sell it to you. So they are not going to really bump the rents a whole amount. So you will get all these rent renewals happening right before you buy it, and you're not going to see those rent bumps for a whole year.
Great point.
6 months, et cetera, into it. So rent bumps being super high across the board is a big red flag for me. Acquisition fees, I look for that. I ask for a detailed breakdown of the closing costs. Another big red flag for me is I ask them what reversion cap rate they used, but I can kind of tell from the NOI that they give you in their pro forma numbers. So what is cap rate? Cap rate is basically I guess it's like a market rate at which a property sells at a certain time, and that varies from location to location. And also now in these COVID times, it's very interesting to see and hard to predict. Did somebody say? Oh, sorry. Okay. So it's very hard to predict that. So I look for NOI numbers to be reasonable. I look for the expenses to be reasonable, in the sense that, did you account for your new acquisition price, like the price at which you're buying this property? Did you account for property taxes increasing enough for that? So that your NOI number is reasonable. And then, so the rent growth is the reason that you increase your revenue. And then your expenses have to be reasonable. And when you subtract the two, that's how you get your net operating income. Is that a reasonable assumption? I look for that. And I look for the reversion cap rate at which you plan to sell the property. So whenever you buy a property, you need to have your exit strategy, right? So I'm buying this property today, I'm going to sell it in 3 or 5 years, whatever that might be. So a reversion cap rate is a prediction of what the cap rates might be in a few years when you're ready to sell the property. You want to make sure there's a difference between the acquisition cap rate when you buy the property and the reversion cap rate when you sell the property, of a 2-point difference, ideally, to be conservative in your underwriting. And that may be too much detail right now for someone brand new to passive investing, but it's basically saying that the underwriting has to be conservative. So don't assume that you can sell the property for the same cap rate at which you buy it. Make it more conservative and still promise the same returns to your passive investor.
Great explanation. That was absolutely wonderful. KK, what are some red flags you look for?
I got a written criteria. So I have 5 red flags on my criteria. I'm going to read them to you.
Ooh.
So the first thing I look at, if none of the syndication partners has been through the whole cycle.
Explain that quickly, if you don't mind.
So if there is a team of 4 sponsors, so at least 1 or 2 of them should have been through the whole cycle. Means they have been, by doing this for 5 years, they have bought the property, done the renovation, and sold the property.
Great.
And the second one is, none of the key sponsor are full-time multifamily operators. So if none of the key sponsors are full-time, I would not invest in that deal. And the third is, if there is only one partner and he may have experience, he may have 15-year experience. If he's the only partner and nobody else, then I don't invest in that deal either. Because what happens to all the properties, even if he has 10 properties, if for some reason he passes away? And who knows? So it's a big responsibility to have on just one person's shoulders. And the fourth one is no preferred return. If there is no preferred returns, and I have seen in Dallas area, mostly it's 80-20 split, straight 80-20. That's not my way of investing. I need a cash flow. I need at least 7 or 8% cash flow monthly or quarterly. Whether I need it or not, but I want to invest in that deal where there is a cash flow. And the last one is, not the least, if they have no skin in the game.
Right.
So if they have not invested their own money in the deal, I wouldn't invest in that deal either. And a lot of times they just invest the acquisition fee. So they'll get 2% or 3% acquisition fee. I don't like that idea either. I want them to have at least $100,000, if not more, in the deal per sponsor. And I always invest my money in the deals I sponsor. I always.
You put your money where your mouth is, KK. That's one of the things I like about you, my friend.
Correct.
Spencer, tell me, red flags. What do you look for?
Yeah, so 2 things to call out. First I'll rattle off in case folks are taking notes or we're going to share the recording. Here's the things we look for on the sponsor level, just as buckets. So we look at track record, approach, the team. We look at the communications that they typically have. But we also, here's the point I was going to make. We look at values. And this is where I actually don't hear really anyone talk about this on any podcast or any other meetup. And the reason why I feel comfortable saying it, and it's not a squishy thing, it's actually quite concrete to me, is because I had a lot of experience putting into practice building high velocity organizations in Silicon Valley. So what I mean by that would be, here's a question I will ask a sponsor before we feel comfortable either investing in them in a project or partnering with them on the active side in the GP, which is, what is your philosophy on tenant relations? And I have gotten really smart, very well-known sponsors who really just change the subject and don't acknowledge that like that's a real question. It's deadly serious to me. I think that right now, particularly in the middle of a pandemic, I would think most people would agree with me, given that we're watching collections like a hawk and we're wondering how people are going to do without stimulus money. So it matters that people care about their tenants, in my humble opinion. That's a pretty, I'm not saying that's contrarian, but it's seeming to be occasionally within the real estate community. So that's one thing I look for. Another thing I look for very clearly is this thing called failure response. And what I mean by that is oftentimes, I totally agree with what KK said about looking for, full cycle sponsors. But that said, even for the downside of repeat 2 to 3 cycle sponsors, I've talked to folks that have been in real estate, and I know quite a few from growing up in a real estate household. They've been in real estate 30 years. They're not as engaged as they used to be. So we're all trying to make intelligent, critical decisions in this real estate game. And before we put a 5 to 6 digit number into a project, what I want is someone who is going to work tirelessly for the right reasons to preserve my capital, and is going to do everything they possibly can to make an incredible living experience for the people that pay the rent. So I want to know, what is the hardest singular business event they have ever gone through, and how did they navigate it? And if they don't take that question seriously, I don't think they're going to take my money seriously. And it speaks all the way back to a capital call. So if you're sitting out there talking to a sponsor, guys, and you're considering investing passively, ask them, have you had any capital calls? Capital call is when you got to put more money into the project to get out of the project. And it's one of the most notorious moments that you can get as a passive investor. And that's not a good thing. So what we look for is a team that's going to handle moments like that responsibly, and that they're going to come back and say things like, you know what, I have navigated this incredibly challenging entrepreneurial thing, and it doesn't always have to be a capital call. And I will invest in a sponsor who hasn't necessarily gone full cycle. And it is because I can find out other ways that I think that they're in this to actually go and win at a level that, frankly, other people might not necessarily give them the credit for, because they're fully engaged, they're highly capable, they have a good balance sheet, which means they have enough money, like 6 plus 12 months reserves, all that stuff. So failure response is a big deal for me. So I just wanted to give you something fresh. I think the comments made so far are excellent, but a little contrarian view for you guys.
Yeah, that's an additional really, really great point. Thank you for that. We're running a little low on time, so I want to make sure that we have a minute for this Q&A. I see a couple questions in the box here, but each one of you has mentioned a different checklist in terms of your decision-making processes. And Spencer, I think you put it perfectly: steal a good idea and then make it your own. Would you be willing to share those with our community here so that we can send them out in terms of how you've chosen to make your decisions? And if so, we'll definitely pass that along.
Yes.
Okay.
For sure.
I have a list of 43 questions, 43 or 44 now. So I'll email you right now.
I love it. Thank you so much. We will absolutely follow up with that. And then as we're getting to the Q&A, I think now is the perfect time to mention a book that I think has totally knocked it out of the park. Spencer and I think the rest of our guests too have mentioned Bigger Pockets quite a lot. And I also did a lot of weird listening of books and podcasts. And I tore through this book when Jeff on our last meetup talked about it, the Hands-Off Investor. If you haven't seen it, it's at Bigger Pockets, or you can get it on Audible. And the way I get more information in, you guys, is I listen at 1.5 times speed. So you just get it more, you get in there quicker. So if you want that little hack. But anyway, so our big surprise, you guys, is whoever shares something that they experienced on this podcast, learned on this podcast, this is a podcast, meetup, and thinks is great about this meetup, on your Facebook page, whoever ends up with the most likes by 7 p.m. on Friday, you let us know and we'll send you this book. Okay, so your chance at a contest. And we'll follow up with all that collateral. So, Brian, I'll toss to you for Q&A.
All right, thanks, man. Spencer, KK, Sandia, that was awesome. Just have a couple questions here that came through the chat while you guys were talking. First one, do you have a baseline IRR that you look for in a potential investment? Sandy, I'll start with you.
I follow cash flow more closely than IRR because I think the number can be manipulated pretty easily. So I actually say, okay, if I give you 100K today, what does my cash flow look like the next 5 years? And is it pref return, or is it just based on how well you operate the property and I might not see any money the first 2 years?
All right, next question. Now, Spencer, I'll send this one over to you. Somebody said they just sold a business and will have a capital gains tax debt of about $75,000 if they don't find an investment to offset it, like a multifamily with a nice depreciation and tax segregation in the next 6 months. If you were in their shoes, where would you look for a deal on relatively short notice?
Wow. Well, congratulations on selling the business, first and foremost. That's exciting. You know, I think one thing I wish I had known earlier as an investor is the power of having those, it's like the power of relationships for connectors and specialized firms, because there's firms that are tax specialized and that they will be very well connected into a network of people and that a bunch of sponsors, you know, so you can basically go talk to one or two of these firms and immediately find out, hey, maybe they're already in conversations with some other folks that are putting together deals. And so that would probably be my personal first place that I would go, is to go talk to, you know, folks that do things like, you know, like deferred sales trust, you know, like just there's different types of tax firms that specialize in this. And so that would be the first place I would go, particularly if you're on short notice, because you kind of have to look for ways to shortcut the research, because you can go way down a rabbit hole. The mistake I have made, and I will just warn against on this briefly, is talking to a sponsor and indicating to them you have these gains and that you maybe invest with them, because think about it from their perspective. They're thinking, oh, cool, an investor wants to talk to me. So they're not going to push you away immediately and just say, we're not a fit. And you're going to lose valuable time on your clock if you're trying to go identify the next investment. So if you do want any, you know, if you want to reach out and get any recommendations for other firms, this is not a paid thing. I don't get any kickbacks for these firms. You know, I'm happy to give recommendations for places.
Yeah, great advice. Thank you. KK, I'll send this one to you. So a couple people have asked, what is a typical minimum passive investment amount, and do you need to be accredited?
The first question is, the answer to the first question is, most of the syndications are 50,000. They start at 50,000. And some of them will go less on their previous investors or even new investors. But I would say that means they are more desperate. They're more desperate to get your money. So they might go down to 25,000 even. I have not seen less than 25,000. Maybe I have heard that people sometimes get only 10,000 also. But you don't have to be accredited to invest in multifamily if the deal is 506B. So if the offering is 506B, then you don't have to, then you have to have a relationship with the sponsor. And there are rules and regulations regarding that. You have to have 3-touch rule. It's called 3-touch rule. So you might have, you have to have 3 times conversation with the sponsor, substantial relationship, existing relationship with the sponsor to invest in their deals. So you can't offer them right away that, oh, I have a deal and we haven't met before. I met you at the Chicago boot camp or somewhere, so now invest. That's illegal.
And then we have one more from Omar that just came in. Sandy, I'll go back to you with this one. In an environment where the passive investor may need to reduce their expectations in terms of returns, would you agree that the sponsor may also need to reduce their expectations in terms of reducing their fees, such as acquisition and disposition fees?
So first of all, I am not a huge fan of acquisition fees. So if you want to email me, I can give you a list of sponsors I have invested with in the past who do not charge any acquisition fee at all. They're experienced sponsors and do a great job. So yes, and then the environment where the passive investor may need to reduce their expectations on returns. I think in general, within 5 years, if you should get at least a 70% return. And I think there are many deals today that are still available, which have those kind of returns. So I don't know what your current expectations is. I know some time ago, people used to expect their money to double in 5 years. I would say 70 to 80% in 5 years is pretty reasonable. Look closely at that reversion cap rate because that can make all the difference to that return. And I will provide my email address here if you have any more questions or want references to good sponsors who don't charge acquisition fees at all and still provide great returns.
That'd be great. Thank you. So that's going to do it for the Q&A. Mandy, Kevin, any last comments before we start the breakout rooms?
Just so that we're clear on our contest, you guys, post something on Facebook that you got of value. Whoever gets the most likes, you've got to tag Brian, me, or Kevin, or all 3 of us. Whoever gets the most likes by 7 p.m. on Friday, the 10th, then we will be sending you, we'll contact you and we'll send you this book that I thought was just, I have nothing to do with it. I just thought it was absolutely fabulous. And so it's what we're talking about here. So if you have interest in staying on and doing a little bit of breakout session, you know, please do. I've made some pretty good contacts and caught up with some old friends. Thank you, Spencer, KK, Sandhya. You all are incredible wealths of knowledge who are just givers. So that's apparent in what you're doing here. So thank you from the bottom of everyone's heart here.
Thank you.
Thank you so much for having us.
Thank you for having us.
We'll make sure to email everybody the contact information for Spencer, Sandhya, and KK so you guys can reach out as you like as well.
Thank you.
Thank you so much, guys.
Thank you.
Right. I'm going to try to
All
put some
right, let's get to it. We can
breakout rooms
probably
here.
stop recording and then we can go to breakouts.